Please, if you are new in this space, if you've never done this before, do not let anybody ever tell you they are predicting where price is going. Just throw that word out of your vocabulary, because if you really want to be a technical analyst and you really want to try to find setups that are profitable, that will allow you to extract money from this market liquidity, you do not want to be in the habit of predicting, because predicting sets you up for failure. You want to be in the habit of coming up with a strategy that leverages good risk to reward opportunities. One of the things that we do at TradeX Academy is we love taking technical analysis and really looking for long-term potential entries, especially in crypto. Crypto is so new relative to the other financial markets. It moves very quickly, and you have to be very cognizant of the risks involved in this sector. For me personally, my goal is to build an investment portfolio for the long term on some of the more promising projects that I know will be here for a long time. This is very much to me, and I'll see what Stephen thinks about it later. This is very much to me, it's akin to the dot-com era, where you have this new shift in technology that's going to be greatly ingrained in a lot of people's everyday lives, to the point where they may not even be aware of it in the near future. But there's going to be a lot of things that show up that don't pan out as well. So there's very much a high risk, high reward situation, and you have to be aware of the greater market structure. So you'll see here, I'm on a log chart, and if you do any technical analysis in crypto, I strongly recommend you use logarithmic charts. And if you want to know why, we cover it in our course as well, but suffice it to say, log charts will show you percentage moves and not just raw dollar moves. It's very easy for me to see here was a bearish cycle, a bullish cycle, a bearish cycle, and a bullish cycle, because I'm on log and I can see the relative action in the big picture. Now, one of the things that we offer in TradeX Academy is our basic subscription, in which we provide 5 days a week in-depth market analysis on just about all of these charts you see over here on the side. And we're shifting out a few charts every week, but we always cover Bitcoin and Ethereum and some of the major cap coins that are making some of the stronger moves. The goal being that people who don't have enough time to follow this market that runs 24/7 all the time can get in that information about 10 to 15 minutes and know if anything big has happened. That's what we're really trying to accomplish here. I'm very excited tonight. We are doing a special live session, a little bit of a pop-up in our community, and we have Stephen Harano with us. Did I say it right, Stephen? I never even asked you on your last name.
Yeah, pretty close. Harano.
Harano, almost. I was very close. Stephen Harano with us. He is fantastic at Elliott Wave analysis. I would consider him a very valuable resource, and we're so grateful to have him in our community. He started the tradeschool.net, which is another place that offers this style of technical analysis training. He has a course specifically in Elliott Wave, so feel free to go and check them out, especially the Elliott Wave course if you find tonight exciting. I know I'm going to. I'm a little pumped over here. So right away, if I just give a sample analysis so you can get a taste of what we do in that kind of sphere of things. This is a look at Bitcoin in the local price action, going from the all-time high back in November to where we are here all the way over in March. So far, since we dropped into this area back in January, we've just been moving sideways on Bitcoin. Some people see a little bit of different subjective patterns when they perform technical analysis. I know there's traders out there that are seeing this as a bit of a triangle pattern. To me personally, I see this downward channel of price action, and then something different happens where we break out of it. And now we're making a successive series of higher lows and higher highs. And when you're in a downtrend and you start to pull back off of it and you start to make these higher highs and higher lows at a certain angle, about 45 degrees, give or take. Of course, it's going to change based on your perspective, but you get used to seeing this. We call this a bear flag pattern. So those of you that are new to technical analysis, that may be a new term. If you've done any technical analysis, this is a pretty simple, familiar term. And this is a very, very top-down looking, simple approach to technical analysis, just to give us an idea what might happen in the near future. What does probability say? Well, based on this type of a technical analysis pattern, the high probability in this movement here is that if we don't make some kind of a breakout of this pattern, we don't extend beyond this channel here that we've formed, probability says we're going lower, especially if we break out of the bottom. This is what's known as a continuation pattern. So here we are waiting for this continuation to go and test supports down below. And without going into too much detail tonight, because I know we've got a whole lot to cover, this is a local retracement Fibonacci series. And this is a measurement of after we moved up to the high, how far did we retrace of that upward movement? And you can see this is the 786 fib. We retraced 0.786 out of the whole move. That ratio, 78.6% of this entire move in terms of percentage returning back to where we bounced at the support. Now, I'm talking really fast for some of you who might be new, but those of you that know anything about analysis should be following along just fine. The interesting thing that I love about our community is that we have people from all backgrounds, all skill levels, people who've been using Elliott Wave theory for a while, people who don't even know what it is. And I love the fact right now, Stephen, as we've been covering in some of our live sessions in the past on Sundays, that Elliott Wave theory is really kind of in line with what the simple view is looking like. If you follow a certain forecast in Elliott Wave theory, there is a suggestion that there may be a lower low in the near future to complete a certain pattern that I'm not going to go full detail on because it'll just shoot right over some people's heads right now if we don't take our time going through it. Myself, Giorgio, who's here with us tonight. Hi, Giorgio. I see you down there. We've done some covering of just what are the basic rules of Elliott Wave theory, and then taking those rules and scratching the next kind of layer down. Where are we in the big picture on Bitcoin? Why does it make sense for Bitcoin to get back to this kind of long-term trend line area and fix up some of this stuff that's happened in the past, both from a simple support and resistance analysis, from a long-term logarithmic trend analysis, but even further from an Elliott Wave standpoint, when you have all these different views that are coming together and generally saying, you know what, something looks like something important is coming really soon. That's when I start to really sit up and pay attention and I wait for that significant event. Because if Bitcoin provides this move here and pushes back down underneath that 30K support, cleans up this area, which by the way is a CME futures gap. If you're familiar with Bitcoin CME Chicago futures, there is a gap right about 24,000 that's never been closed. And if you know about Forex and other markets and technical analysis in them, oftentimes they like to close gaps of liquidity. So there's a whole lot of events kind of colliding here to give us these cross confirmations that there's a strong indication Bitcoin could head lower.
All right, everybody can see my blank screen?
Yes, we have it.
All right, awesome. I'm going to start with the absolute basics so that we can build on this foundation and really project as to why this is important. I'm also going to pull up some notes and a couple of windows here. So first and foremost, what is the Fibonacci principle or the Fibonacci ratio? So the Fibonacci sequence is nothing more than adding two previous numbers together to get the next number. So if we start with 0 and 1 and we add those two numbers together, we're going to get 1. If we add those two numbers together, we get 2. If we add those two numbers together, we get 3. If we add those two numbers, we get 5, right? All the way on up. And this will continue to go, right? 18, let's see, 8, 13, 21, 34, 55, 89, 144, 233. I mean, you could just keep going and keep going and keep going and keep going. The reason that is important, and I don't want to get into the theory or the foundation of why it was created, but understand that this is a naturally recurring ratio within the world, the galaxy, the universe. You can see these patterns when you start dividing these numbers and using these numbers in mathematical relationships. You can see these patterns reoccurring in just about everything that you see. You can see it in the veins of a tree leaf. You can see it in the pattern of a snail. You can see it in the formation of a tornado, of a hurricane, of the shape of a galaxy. Hell, you could even see it in the way that your toilet bowl flushes, right? It is literally in everything. All right. But it's not just those two numbers. So someone spit out a number for me. Any number.
42.
42. Somebody give me another number.
Giorgio put 69.
All right.
Sim said 85.
I like it. So we're going to use those two numbers, 42 and 69. I'm also going to bring up a calculator so nobody thinks I'm cheating. We'll go ahead and take that. 42 and 69 is 111. All right, so 111. And then we add those two numbers together. We get 180. And I'm going to show you why it doesn't matter what numbers you use. So 180 and 111, 291. And we could just keep going and going. I'll just do a couple more just for grins. We'll do 471, 762. Why not? One more, 1233. Okay. So now when we take these numbers, you're going to find that we have unique ratios. Now, remember earlier when Mike pulled up, he was talking about his Fibonacci retracement levels, just a simple retracement level. You have these series of numbers. What does this mean? 236, 382, 56, 18, 78. What do those mean? Those are relationships between these numbers. All right. So we have, if we were to take any one of these numbers and divide it by yet another number, you can come up with some sort of standard ratio. So let's take 55 over 144 and we get the 382, right? You round that 9 up, we get 0.382. If we were to take the two numbers that are side by side, any one of these two numbers that are side by side, let's say 55 over 89, we get 618. If we take 89 over 144, we get, guess what, 618. If we take the next one, 144 over 233, we get 618. This is the math behind how we derive these ratios, why these are important. And as soon as you understand how this integrates with Elliott wave theory or the wave principle, it's going to blow your mind. Now, I asked for these two random generated numbers because I want to show you that it doesn't matter what numbers you use. So if I use 762 over 1233, which are the last two numbers in our sequence here, what do we get? We get 618. If we come back over here and we start using our Fibonacci extensions, or what I call the target tool, you can see we have these extension levels, 1.618, 2.618, 3.618, 423. We could even go up to the 6.85 or the 11, right? Depending on how far you want to go up there. Those are all, every single one of those are relationships between those numbers. All right, pull up the calculator again. If we turn it around and we say, instead of 55 over 89 or 762 over 1233, let's do it the other way. 1233 over 762. What do we get? 1.618. All right, those numbers, these numbers is what drives all of the market psychology within the financial markets. It's incredible. And I mean, once you realize how everything integrates, it's life-changing. I mean, it really changes the way that you will look at your financial markets. So let's move into some Elliott wave here. So we know from our earlier teachings, Elliott wave is a series or a cycle of 5 waves up, followed by 3 waves down and a retracement. And the reason for that is because it's the most efficient form such that forward momentum or forward progress can maintain while still allowing for corrections. All right, that is yet another massive golden nugget that just goes into a deep, deep, dark rabbit hole that you'll never come out of once you start.
I've lost people to that rabbit hole.
Yeah, it's pretty intense. Okay, I'm going to go ahead and just drop a vertical line here just to kind of separate our wave structure, so you can see the difference between what we call an impulse wave, or this is a motive wave, but specifically it's an impulse wave versus our corrective wave. All right, and I'm going to go ahead and drop a horizontal line here as well. And I'm just going to put it down here, and we're going to annotate these as quadrants. So I'm going to put a text box here. I'm going to put a text box here, and I'm going to put a text box down here. So nobody is arguing the point or contesting the point that a standard Elliott wave sequence is 5 waves up and 3 waves down. And we also understand that the financial markets operate in a fractal nature, meaning what happens on the smaller time frames is going to happen on the larger time frames and vice versa. Why is that? I'm an analyst by trade. I have been conducting human source analysis for years, almost 20 years now. As a matter of fact, it was 19 years in October. And one thing that I can definitively say without a shadow of a doubt is that humans are very much creatures of habit. We take the same roads to work every day. We shop at the same grocery stores every day. We get gas at the same gas stations every day, right? I'm sounding like a broken record. I don't know how many times I've said that, but because of that predictable nature, our habitual nature as humans, we can then identify those patterns and look to see where they fall, and then we can look for them to occur yet again. So if we have this 5-wave structure on the wave up, and we have a 3-wave structure on the wave down, we can also assume that inside this 1-2 cycle, we have a 1-2 primary, right? So the next thing would be another 5 waves up from here, right? So let's go ahead and identify what that looks like. So in these text box, we have one wave here. This is our corrective wave. Over here, we have one impulsive wave. We're just going to go ahead and total those up. We know that our subdivision of waves is going to be the same basic principle. We're going to have 5 waves up, and we're going to have 3 waves down. We're going to have 5 waves up and 3 waves down. And then last but not least, another 5 waves up. Then on the wave down, this becomes our primary direction. So when we're talking about what is your primary direction, you're looking at the wave of a larger degree. So in this particular case, we can assume that this is our cycle wave 1, and this is our cycle wave 2. Remember that Ralph Nelson Elliott, he created 9 different degrees of wave patterns. And then over the years, due to our modern technology, we now have access to, minutes and seconds and, very, very, very small increments of data, as well as the historics for 50-year data, 100-year data, et cetera. So now in today's modern market, we now have 15 degrees of, Elliott wave. So now our wave of a larger degree, in this case, our cycle wave 2, is going to be our primary direction. So now our impulse structure moves this way. So now we have 5 waves down, and then our counter rally is 3 waves up, and then we have another 5 waves down. In this structure, we saw that we have this A, B, C correction, or we have 1, 2, 3 waves that comprise that wave 2. So let's go ahead and put that 3 in there. And then over here, we have 5 waves that comprise our cycle wave 1. Then inside these 3 waves, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So now we have 13 waves over here. And then over here, we could do the same thing. 5, 10, 15, plus 3 is 18, plus 3 is 21. We now have 21 waves. You see where I'm going with this? Oh, I forgot to add them up over here. So 3 and 5 is 8, and 13 and 21 is 34. All right. You could even further subdivide it, break it down even farther, where this has 5 waves. 1, 2, 3, 4, 5. 1, 2, 3. 1, 2, 3, 4, 5. 1, 2, 3. It's sloppy, I know. 1, 2, 3, 4, 5. And then now, because this is the primary direction of that larger degree, now we go 1, 2, 3, 4, 5. 1, 2, 3. 1, 2, 3, 4, 5. And then this way is our new primary direction. 1, 2, 3, 4, 5. 1, 2, 3. 1, 2, 3, 4, 5. 1, 2, 3. And then 1, 2, 3, 4, 5. All right. So we total all that up, and what do we get? 55. Right? You can count it up. 5, 10, 15, 18, 21 plus 5, 10, 13 is 34 plus another, right? If you want to count them all up, you can, but it's 55. And the same thing goes here. If we subdivide everything down, we're going to get 89 waves, and we total those up and we get 144 waves. You guys seeing this pattern? 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144. Does that look familiar? It is absolute magic, right? So now that we understand why that's important, we can then derive why those Fibonacci relationships or those Fibonacci ratios are what they are. If we were to take our Fibonacci retracement level, I'm just going to draw it from swing low to swing high. Ordinarily, we would want to see that 618 ratio. And we can do that because we know we have 89 waves in this construct, and we have 55 waves in this construct, right? 55 over 89. 55 waves into 89 waves is 61.8%. That's why it is the most common retracement level. Now, for those of you that are joining us from different markets, I know, TXA is mainly crypto, and I know a lot of you are out there from the equities markets or options traders, or even commodities. Some of you are Forex. I will tell you that the 618 is most common in equities, commodities, and mostly Forex. But anything that is new, i.e. crypto, or even a newly listed project, your first, second wave is going to tend to retrace much deeper. And that's due to the inherent volatility. That's why I have the 83.3% ratio. All right. So the 833 is typically where I want to see those new projects or crypto projects have a wave two retracement. It's going to get deeper. So pull out the fib structure and we measure it. It does indeed surpass the 90 and it goes past the 1. So now we're looking at an expanded flat. Here is our 3-wave structure here. So now we're looking for a 5-wave structure to the downside. Where's that 5-wave structure going to terminate? Well, we just said that if we measure the length of wave A or the length of wave W, depending on what you want to look at it. So we measure that leg of money and project it from the termination of wave B or wave X, and we can look down here. So there's our $18,500 target. And then notice that CME gap or the square up, whatever you want to call it there, that would be our target. So somewhere between 1.272 and the 1.618 is where we would want to target. Now, keep in mind, this also should be in a 5-wave decline, right? Remember, 3, 3, 5. So if we look at this yet again, if this is wave 1, we are now in wave 2, right? Where is wave 2 going to terminate? Then we go to a wave 3, and then we go to a wave 4, and then we go to a wave 5.